Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Service International Limited. As is usual at this time of year, I have forgone the usual daily charts and instead I have concentrated on giving a longer term view using weekly, monthly, even yearly charts, but rarely using daily charts. Now, if you would like to discuss any of these charts, I'd only be too happy to take your call. So without any further delay, let me introduce today's longer term chart. Today I'll be looking long term at Chicago wheat. A large part of this commentary has risen itself, or rather is a continuation higher from patterns I'd pointed out 2 years ago at the start of 2020. The first pattern to reprise is the bullish Andrews pitchfork for the action between 2017 to 2019. In 2020, the market decided to test down to the lower time of this, currently at 689, and breach it over many months. However, despite the breach, there was only the one monthly close below it, and prices moved back up within the pitchfork in between the lower time and the middle time, currently at 825, and testing the lower time once again in late 2020, and on 2 occasions in 2021, but never closing below it again. Indeed, in 2021 we saw tests up over the middle time, most recently in November and December, with November significantly making a shooting star pattern type 1 bearish that led to December's bearish engulfing pattern. And that was finally halted by the big 50% Fibonacci line of the 2008-2016 move at 868. So far this month, that's January 2022, we have followed on lower, but not aggressively, and there is limited support below until the market tests the next new significant support below, and that's the lower time, currently 705, of the newer, smaller 2018 to 2020 bullish Andrews pitchfork. Now, I drew this pitchfork last year, prompted by the drop in the middle of the year, and it has been an interesting and fruitful bullish pitchfork, giving the bullish angle of attack since it started. And that's in June 2020. The market has utilized all 3 times, the lower time, the middle time currently at 796, and the upper time currently 888, throughout the end of 2020, especially last year when prices breached but did not close over both the upper time and the lower time. This Andrews pitchfork, like the older Andrews pitchfork previously mentioned, is still valid today. Finally, and by no means least, in fact it probably come to be the most important point going forward, is a big picture pattern that I had outlined 3 years ago. This is what I wrote at the time, and I quote, "The interesting concept of a descending scallop pattern for the whole of 2012 to date action so far. This pattern is not complete, but it has an interesting dynamic. The slope of the move down from 2012 to 2016 is the first element, and it looks like a long slope of an Olympic ski jump. 2017 to date is, and remember this is back then, is whether the market turns up at full speed and flies off the highest point, currently, and in this case, the 613 high from last August. That August refers, of course, to the 2018 high, and that's the end of the quote. Anyway, here is a further piece from 3 years ago about the descending scallop pattern, and I quote, "Now, descending scallop patterns can be both bullish and bearish. In the case of a bullish scallop, the market takes another, more ragged and shorter dip before accelerating higher. Typical move up would be about 1/3 of the length of the long ski jump onto the highest peak. In this case, it would be about 811 or about point X, as it's too early to call it a target, as the market may still expand the rise. A typical move down would be about 30% off the long ski jump, taken away from the low of 387, or at about the 217 level and off the bottom of the chart. It seems excessive, but I feel obliged to mention it." And that's the end of the quote. Well, it may have seemed excessive back 3 years ago, but it certainly turned out to be true on the upside as prices reached point X, which turned out indeed to be a target X at 811 back in November of last year. This is now where it may become even more interesting, as we have the opportunity for this confirmed descending scallop pattern to morph into a possible rounded bottom pattern. It all very much depends if the market holds and continues to ascend, or if target X at 811 becomes the peak of this rally since 2016. Perhaps a key feature is the bump. Yes, the bump. You see, rounded bottoms also often have a bump in the base, which looks like a false break higher, that is controlled only to see the market eventually follow through higher. This is where the dip back in 2019 comes in again, as the action from December 2017 to May 2019 could be seen as this bump. If that turns out to be valid, then we would indeed be in the process of forming a possible rounded bottom over the large 2012 to date action, a huge long-term move. So, things to look out for now. The rounded bottom should ideally see the market up to test the 2012 high at 953. However, as this is a standout high, I would finesse it into looking at the late 2012 highs between 930 to 953. I know it is a wide band, but then this is a really big long-term move. Finally, look out for the construction of a possible handle. This would be a multi-month area of hesitation, channeling sideways with a possible bias to a slight downwards angle. This is the handle, and it would preempt the high at 953 and set off the next measurement of the next move higher. Now, obviously, I cannot give an idea of any possible target for this, as it's not happened yet. But I can give an idea of the size of the potential move higher. It will be in the order of 353 cents on top of the break upwards from the handle. I think I'll just leave you now to ponder upon that for a bit.